Cleveland, Ohio, October 1973. A woman named Dorothy pulls into this Ohio station on Pearl Road at 5 o'clock in the morning. The line stretches 3 blocks. A hand-painted sign on the pump reads, 4 gallons maximum. Last week, there was no limit. The price has doubled in 6 weeks. By January, it will triple. Dorothy has $5,000 in a savings account at Cleveland Trust. It pays 4.5%. She thinks that money is safe. It is not. Over the next year, inflation will eat a third of its purchasing power, and she will not understand why until it is too late. Now jump. Tehran, 1979. The Shah has fallen. Iranian oil vanishes overnight. Oil doubles again. The Dow sits exactly where it started the decade. A lost decade for stocks. Jump again. Baghdad, 1990. Saddam invades Kuwait. Oil doubles in weeks. Recession follows within the year. Same trigger. Same sequence. Same devastation to anyone holding paper. Every single time. Here is the thing that keeps me up at night. Right now, in March of 2026, the Strait of Hormuz is closed. Oil has surged past $100 a barrel. Analysts say 200 is no longer outside the realm of possibility. Iran has promised to make it happen. This is not theory. It is 1973 happening again in real time on a bigger scale with a more fragile global economy underneath it. By the end of this video, you will know exactly which 4 assets survived the last time oil prices exploded and which ones went to zero. Stick with me. Before we dive in, this is history, not financial advice. Do your own research. Now the pattern. Every oil shock follows the same sequence. A choke point closes, supply vanishes, prices spike, inflation surges, central banks panic, paper assets collapse. And then the wealth transfer begins from the unprepared to the prepared. 1973, Arab oil producers embargo the United States after Nixon sent emergency aid to Israel during the Yom Kippur War. Oil goes from $3 a barrel to $12. Quadrupled. The stock market crashed nearly half its value over the next 2 years. It took almost 7 years to recover. Not months, years. 1979, the Iranian Revolution pulls Iranian oil off the market. Oil doubles again. Inflation surges into double digits. The Federal Reserve panics. By 1981, the 10-year Treasury yield reaches nearly 16%, destroying anyone holding long-term bonds. 2026, the Strait of Hormuz closes. 1/5 of global oil supply vanishes. The largest supply disruption in the history of the global oil market. The International Energy Agency releases the largest emergency stockpile in its history. It barely moves the needle. The daily shortfall is 15 million barrels, the entire daily output of the United States. There is no easy replacement. Same choke point. Same spike. Same panic. The question is not whether the pattern is real. The question is what you own when it hits. Number 1 is gold. Here is what blows people's mind about the 1970s. Gold did not just beat inflation. It destroyed every other asset class, and it was not even close. When Nixon closed the gold window in August of 1971, gold sat at $35 an ounce. By January of 1980, it hit $850. From $35 to $850 in less than a decade. Stocks lost purchasing power every single year over the same period. Bonds lost even more. Gold gained 9% a year after inflation. The mechanism is simple. When energy prices spike, everything denominated in paper loses value. Gold is not denominated in paper. It is not printed by any government. It is not borrowed into existence. Here is a detail most people miss. 1 month before the embargo, OPEC passed a resolution complaining that the dollar's collapse had robbed them. They started pricing oil against gold instead of the dollar. Not because they loved gold, because even the people selling the oil did not trust the currency they sold it in. The research paper by Hammis and Wills proved something remarkable. Before the embargo, the price of oil measured in gold had dropped by more than half. The so-called price spike was not just politics. It was OPEC clawing back purchasing power. After the spike, the price of oil in gold terms returned to exactly where it had been. The crisis was a repricing, not shock. Measured in the one currency governments cannot debase, nothing actually changed. Right now, gold has surged past $4,500 an ounce, briefly touching $5,000. The pattern is active. Number 2 is farmland. This one surprises people. During the 70s, farmland was the second best performing asset class in America behind gold. The United States Department of Agriculture tracked it. American farmland went from $137 per acre in 1970 to $737 by 1980. More than 5 times the price in a decade. And that does not count what the land produced. Beef prices doubled, corn nearly tripled, wheat quadrupled. The land appreciated and the output appreciated at the same time. The mechanism. Farmland produces something people cannot live without. Modern agriculture runs on oil. Tractors burn diesel. Fertilizer comes from natural gas. When energy prices spike, food prices spike with them. The cost of food rises. The value of the land that produces it rises with the cost. And unlike gold, no federal government has ever confiscated farmland during a financial crisis. Not in 1933, not ever. There is no executive order for farmland. A government that seizes farms creates a famine. Even tyrants understand that math. If you are realizing that the assets your financial advisor never mentions are the ones that actually survive oil shocks, pay attention. Number 3 is energy stocks, but with a critical warning. In the long run, energy stocks crushed the broader market during the 70s. An equal basket of Exxon and Chevron, held through the decade, returned 5 times what the S&P 500 delivered. But here is the warning the history books leave out. During the very oil shock that should have been good for energy stocks, the 1973 crash, that same basket lost almost half its value, right in line with the broader market. Let that sink in. Oil quadrupled, and energy stocks still got cut in half. The mechanism. In a liquidity panic, everything sells. Margin calls do not care what you own. Energy stocks recovered faster and went higher, much higher. But you had to survive the crash first. If you sold at the bottom, the long-term returns meant nothing. The Nifty 50 proved the opposite lesson. Polaroid, Xerox, Avon. The blue chips everyone loved, trading at 50, 60, 90 times earnings. When the oil shock hit, they collapsed. Most never came back. Polaroid went bankrupt. When inflation surges, the market stops paying premium prices for future growth. It wants value now, not promises. Number 4 is short-term government debt. The boring one. And boring save a lot of people. Long-term treasury bonds got destroyed in the 70s. A fixed yield that inflation ate alive every single year for a decade. But short-term treasury bills, the kind that mature in a few months, kept up with inflation. They roughly broke even. Not exciting. But breaking even while stocks crash and bonds bleed is not boring. It is survival. The mechanism is maturity. Short-term bills reset their rates when inflation rises. Long-term bonds are locked in. Duration killed bond investors. Short duration saved them. Now, what went to zero? Savings accounts. Dorothy in Cleveland with her $5,000 at Cleveland Trust. The bank paid her 4.5%. Inflation ran at 12. She was paying the bank to hold her money. She just did not know it. And here is what the history books skip. The people who hurt worst were not gamblers. They were the most conservative, most responsible savers in America. The people who did everything right, who saved, who avoided risk, who trusted the system. They got wiped out. Not by a crash. By the slow, invisible erosion of their purchasing power, while their government told them everything was fine. The warning signs. Right now, the Strait of Hormuz is closed. The Strategic Petroleum Reserve can release 4.5 million barrels per day. The daily shortfall is 15 million. The reserve cannot fill the gap. It can buy weeks, not months. Southeast Asian nations are already rationing fuel. Thailand and Vietnam have run dry at the pump. People cannot get to work. The mechanisms that saved the world in 1974, spare capacity, alternative producers, emergency reserves, are weaker today than they were 50 years ago. The pattern is visible if you are willing to look. Dorothy in Cleveland waited 3 hours for 4 gallons of gas at 5 o'clock in the morning. She did not know she was living through a wealth transfer. Nobody told her. The newspapers called it a shortage. The government called it temporary. Her bank told her savings were safe. Meanwhile, Bunker Hunt bought silver at $3 an ounce because he studied Weimar and understood what happens when paper currencies lose their anchor. He was right until he got greedy with leverage and the government changed the rules. But the instinct was correct. Physical assets outside the banking system held their value when paper assets did not. Dorothy trusted this system. Bunker Hunt trusted history. The pattern is mathematical. The outcome is inevitable. The only variable is you.